You're spending more on Netflix than you are on your future. And before you get defensive, let me prove it. 70% of Americans have a Netflix subscription. 75% are living paycheck to paycheck, which means most of you are funding someone else's dreams watching dumb movies, instead of using that money to fund your own. That's not discipline. That's financial suicide. But Netflix isn't even the worst part. There are 6 other mistakes quietly destroying your wealth right now, and I'm about to rank all 7 of them, from bad to catastrophic. Let's go. Mistake number 1, you're not even in the game. Most Americans follow one of 2 religions, spending or saving, and both will keep you poor. Let's start with the spenders. Somewhere between 55% to 75% of Americans, depending on which study you trust, are living paycheck to paycheck, flat broke. You make money, spend it on rent, groceries, the car payment, and then sit there wondering why you can't afford a vacation. But here's the kicker. A 2025 study just dropped. Over 70% of Americans own a Netflix subscription. Do the math. That means most of you are spending more on Netflix than you are on your investments. Let me say that again. Most of you are spending more on Netflix than you are on your investments. You're paying $15 a month to rot your brain, while your dreams are stuck in that same rotting brain. I'm not saying cancel Netflix. I'm saying if your entertainment budget is bigger than your investment budget, you've got your priorities backwards. Now the savers. I had an Indian friend who grew up in a traditional Indian household. Save-heavy culture. I used to joke, Americans make $1 to spend $2. Indians make $1 to spend 20 cents. You work hard, become a doctor or engineer, make a big salary, and then you don't spend anything. Sounds smart, right? Wrong. Your savings account is a slow-motion robbery. If the average savings account pays 0.5% interest and inflation runs at 3%, you're losing 2.5% of your buying power every single year. You save $100? You just lost $2.50 in value. You save $1 million? Congratulations! You just paid $25,000 for the privilege of doing nothing with your money. Saving has a time and place, but saving everything is not how you build wealth. Investing is. Mistake number 2, the casino effect. Warren Buffett said it best. More and more people are treating the stock market like a casino. And the apps? They're making it worse. Robinhood adds confetti when you buy a stock. They gamified losing money. And here's the trap. Slow compounded growth sounds boring. The average market return is 10% a year. Who wants that when Bitcoin's doing 100%? Let me tell you something that'll hurt. The best investor in human history, Warren Buffett, averaged 19% a year. Not 100%. 19. And he's one of the richest people on the planet. You know why? Because consistent compounded returns over decades beat flashy wins every time. I'm not saying crypto is bad, I own some. I'm saying if you're chasing 100% returns without understanding the risk, you're not investing. You're gambling. Here's how I do it. And I'm not telling you what to do, I'm just showing you what works for me. I'm diversified against disaster. I own my business, real estate, stocks, speculative assets like crypto and startups, and about 2% in physical gold. Speculative stuff? 18% of my portfolio. And I only expanded that after I got rich off the boring stuff, stocks and real estate. If my crypto went to zero tomorrow, I'd be fine. Can you say the same? We've seen 16 recessions and 25 market crashes in the last 100 years, and we'll see more. When those crashes hit, the speculative stuff falls the hardest. So if you're just starting out, understand, speculative investments can make you rich fast and broke faster. History doesn't repeat, but it rhymes. And the rhyme says, don't bet the farm on the flashy stuff. Mistake number 3, missing the big moves. Warren Buffett's got another one. Time in the market beats timing the market. Nobody, and I mean nobody, can predict when the next crash, bottom, or top is coming. So stop trying. Just keep buying. Every week, every 2 weeks, every month. Let your money sit in the market and compound. Bank of America ran the numbers from 1930 to 2020. 90 years of data. If you just held your money in the market, 17,000% return. But here's where it gets wild. If you somehow avoided the 10 worst days per decade, you'd see a 3.7 million% return. Sounds amazing, right? But if you missed the 10 best days per decade, you'd only get a 28% return. 28% over 90 years. You see the problem? Nobody knows which days are the best or worst until after they happen. So the only move is to stay in the game. Time in beats timing. Every time. Mistake number 4, investing on emotion. Markets go up, markets go down, And every time they go down, people panic and sell. And that's when the wealthy get wealthier. Let me show you the pattern. 2022, S&P 500 fell 20%. 2020 fell 34%. 2008 fell 57%. 2000 fell 50%. And every single time, people sold at the bottom. I call this the poop. Panic leads to overselling, leads to opportunity, leads to profits for the people who don't panic. Poop happened in 2000, in 2008, in 2020, in 2022. And every single time, financially savvy people got rich buying what scared people were selling. If you're a long-term investor, you cannot let emotion drive your decisions. Downturns aren't disasters, they're discounts. Recessions and crashes create more millionaires than any other time, because the smart ones buy good investments at fire sale prices. The question is, are you the one selling in fear or buying in confidence? Mistake number 5, short-term thinking. Options, forex, penny stocks, day trading. It's easy to get caught up wanting to flip stocks like you're flipping burgers. But here's the truth. As an investor, your goal is not to flip. It's to own, for years, for decades, ideally forever. If you hold a good investment long enough, compounding does the heavy lifting for you. And here's the bonus. If you hold for more than a year, the government rewards you with lower taxes. Long-term capital gains rates. Why? Because historically, holding investments long-term works. It reduces risk. It increases your chance of making money. Short-term thinking? That's just gambling with a brokerage account. Mistake number 6. You ignore fees. Most people don't even know they're paying them. 401k, financial advisor, ETF index fund, mutual fund, all of them charge fees. And those fees compound just like your money does. Let me give you an example that'll make you sick. Say you invest $1,000 a month for 30 years. Average return, 11%. If you use a financial advisor charging 1.5%, they'll take about $600,000 in fees. You'll be left with $1.8 million. Now, same scenario, but you use a low-cost index fund with a 0.1% expense ratio. You'll pay around $40,000 in fees. You'll be left with $2.34 million. That's a $540,000 difference. Same money, same time, different fee. Look, if you need a professional and the fee is worth it to you for peace of mind, fine. But know what it's costing you, because that small 1.5% fee just cost you over $500,000. Mistake number 7, you don't have a strategy. There are 3 ways to invest. Most people flip between all 3 and wonder why they're losing. 1, completely hands-off. You give your money to a financial advisor. You must find a good one. Understand their fees. Make sure their goals match yours. 2, passive investor. You put money into funds, ETF, index funds, mutual funds. You're not picking stocks, you're buying baskets. 3, active investor. You're in the trenches, reading earnings calls, studying financial statements, trying to beat the market by 2% or 3% a year. Most risk, most potential reward. Here's the problem. Passive investors say they'll invest in the S&P 500 and hold forever until the market drops 20%. Then they panic, sell at a discount, and the wealthy buy what they just sold. I've seen this in 2020, in 2022, in 2025. Every time the market dips, people freak out and sell, and every time, the disciplined investors get richer. So here's how you win. Hands-off investor? Get a great advisor. Know their track record and fees. Passive investor? Follow ABB. Always be buying. Set it. Forget it. Buy every week or every month. Up markets, down markets, doesn't matter. You hold for the long term. Active investor? You win by studying where money is moving before it hits the headlines. Before CNBC talks about it. Before Reddit pumps it. You invest based on data and research, not hype. But whatever strategy you pick, stick to it. Because flipping between strategies is how you lose. Now for your homework, open your investing app right now. Look at your portfolio. I want you to answer 3 questions in the comments. Which of these 7 mistakes are you making? What's your biggest investing fear right now? Are you a hands-off, passive, or active investor? Be honest. No judgment, just accountability. Because you can't fix what you won't face. Drop your answers below. I'll read every single one. This is Professor Chalkman. Class dismissed.